Asset allocation using stocks and bonds. A common approach to asset allocation using stocks and bonds is to use the 100 minus your age rule, where you allocate a percentage of your portfolio to stocks equal to 100 minus your age, with the remaining portion going to bonds. For example, a 30-year-old would invest 70% in stocks and 30% in bonds, while a 60-year-old would have a 40-60 split, reflecting a more conservative approach as they near retirement. Key points about asset allocation using stocks and bonds. Risk tolerance. The primary factor determining your allocation is your risk tolerance. Younger investors with a longer time horizon can typically tolerate a higher percentage of stocks, while older investors may prefer a larger bond allocation for stability. Investment goals. Your financial goals also influence your allocation, with aggressive growth goals leaning towards more stocks and conservative income goals favoring bonds. Diversification. The key to effective asset allocation is diversification, meaning spreading your investments across different asset classes to mitigate risk. Different allocation strategies. Aggressive, high percentage of stocks suitable for young investors with high risk tolerance. Moderate, balanced mix of stocks and bonds, often considered a standard approach. Conservative, large proportion of bonds suitable for investors nearing retirement with a focus on capital preservation. Important considerations. Rebalancing. Regularly reviewing your portfolio and adjusting allocations to maintain your desired asset mix as asset prices fluctuate. Stocks generally have a higher standard deviation and are considered more volatile than bonds, meaning that stock prices fluctuate more significantly around their average price compared to bond prices, making stocks inherently riskier investments than bonds. This is because the future performance of a company's stock is less predictable than the fixed income stream of a bond. Key points about standard deviation and volatility between stocks and bonds. Again, high volatility in stocks. Stocks are typically more volatile than bonds, meaning their prices can swing more dramatically, resulting in a higher standard deviation. Reason for lower bond volatility. Bonds offer a more predictable income stream with fixed interest payments, which contributes to their lower volatility and lower standard deviation compared to stocks. Risk implication. A higher standard deviation indicates greater risk, so investors looking for stability often prefer bonds over stocks.